intra-group trading, and after intra-group trading we discussed about the current account balance, and after the current account balance the next area that we discussed was the purchase consideration. Now these are the areas which we have already discussed, and normally when we talk about the question, in question number 1 you are going to have part A, 1 and 2, which is going to relate to the area of consolidation, and even in this part 1 is normally going to be related to these areas. Part 1 is normally going to be related to these areas, and part 2 is going to be relating to some advanced consolidation areas, which includes the disposal and which includes the step acquisition, and this includes the foreign subsidiary, this includes the cash flow statements, and this includes the income statement. So these are the areas which are normally part of the consolidation. We have covered these in day 1, and today's target is to solve some of the past papers relating to these areas, plus we are going to start the area of disposal today. And similarly, in the next class we are going to cover the area of step acquisition along some further past papers of the area of disposal. And in day number 4 we are going to discuss mainly the foreign subsidiary, and then day number 5 is going to relate to the income statement, and similarly the last day is going to be the cash flow statement. So this is probably the 6-day plan for the area of consolidation. Out of the total of 20 classes, we are going to solve 5 to 6 classes to the consolidation, and then after that we're going to start the area of the accounting standards. So this is the way forward. A lot of people were asking about what our plan is going to be, so this is what we are going to plan. Okay, Sufyan is having some internet problems. Sufyan, I think there's some internet problem from your side because we are clear on the voice. Abhishta is saying, I think we did not cover the contingent consideration. Abhishta, don't worry, we are going to cover this. Basically, the contingent consideration is also a part which is important. So let me change the presentation, and then we're going to resume that. Just give me a second for that. Okay, so we are starting with a question, and then we are going to discuss the contingent consideration as well. So there's nothing to worry about that. And this is a past paper question which relates to specimen exam number 2, which was officially published by the ACCA. And in this, I'm going to the requirement first, and then we are going to solve this question. Okay, Sufyan is clear on the voice now, but Dilpreet is saying that the voice is not clear. Dilpreet, if you can please check the internet connection at your side. Okay, so now this is the question number 1 of the specimen exam number 2, which we are starting to discuss. The question says that in the requirement part A1, in respect of the investment in Chandler, explain with suitable calculations how goodwill should have been calculated. So this is the main requirement of the question, that how the goodwill should have been calculated. So the goodwill calculation that we had discussed previously was in the working number 2. So we are going to prepare working 2 for that. And the question further says, then show the adjustments. Show the adjustment means prepare the double entry. Show the adjustments means prepare the double entry which need to be made to the consolidated financial statements for this, as well as an implication of the recoverable amount calculated. So we also need to discuss any implication of the recoverable amount, which means the question wants us to calculate the impairment as well. Calculated on 30th September 2016. So if we see, the question is giving us a total of 13 marks for this. 13 marks for the area that we have covered during our last session. So I'm going to solve the answer in the worksheet. So this is a Word document where we are going to write down the answer. And we are solving specimen exam number 2. And we are solving question number 1, part A1. So I'm writing this answer. This answer will be shared with the people. And I've created your online access on our website of ibfglobal.com. I'm going to share that on the personal numbers that you people have shared in the form that you people have filled. So we can discuss the further procedure over there. So now, if I go back to the question says that Hill is a public limited company which has investment in a number of other entities. All of these entities prepare their financial statements in accordance with the International Financial Reporting Standards. Extracts from the draft individual statement of profit or loss of Hill, Chandler, and Doyle for the year ended 30th September 2026 are presented below. So these are the extracts from the individual statement of profit or loss. So individual profit or loss was 45 negative, 67, 154, the taxation and the profit for the period. But the question's first requirement is relating to this part, which is the acquisition of Chandler, 80% of the Chandler. Now the question says that Hill purchased 80% of the ordinary shares of Chandler on 1st October 20x5, which means at the start of the year, 1 year ago from the balance sheet date. Cash consideration of 150 million, has been included when calculating goodwill in the consolidated financial statements. So far the treatment is correct because we have paid the cash consideration and which is already included in the goodwill. So there's no problem up till now. But let's read further where the question says that the purchase agreement specified that a further cash payment of 32 million becomes payable. Becomes payable means this is a deferred consideration which we have discussed previously, and we're going to pay this on 1st October 20x7. But no entries have been posted in the consolidated financial statement in respect of this. A discount rate of 5% should be used. So this means we are talking about a deferred consideration, and whenever we talk about a deferred consideration, if I write it over here, we are talking about the deferred consideration. And whenever we talk about the deferred consideration, we are going to record this at what amount? At the present value of future cash flows, and whatever amount is calculated at the present value needs to be unwound or unwinded at the each year end. I hope you people are clear this on this accounting, because this is what we have already discussed in the previous slide, in the previous lecture, in day 1. Now, if I go back to the question was asking that how the goodwill should have been calculated. So we can say that when calculating goodwill, an entity should include all types of, let me remove this first, all types of purchase considerations, including any deferred consideration which is included at its present value and recorded and even recorded as a liability. This liability is then unwound at each year end. So this is a first statement that we have written, which is a general statement talking about the correct treatment. And after this, we are going to apply it onto the scenario. So we are going to say that in case of Chandler, Hill, which is the parent company, Chandler is the subsidiary company, should incorporate how much of the amount? It was $32 million payable after how many years? 2 years. And the discount factor was 5%. So we are going to say $32 million divided by 1.05 to the power 2. This is how we are going to calculate the present value. So if I use a calculator to calculate this, and I'm using a scientific calculator, so this is going to be 32 divided by 1.05 to the power 2, which will give us a value of approximately $29 million. So we are going to say that Hill should incorporate $29 million as a deferred consideration while calculating goodwill. Further, the liability shall also be unwound by how much? $29 million into 5%, which is going to be 29 into 0.05. This is going to be 1.45. So it should be unwound by $1.45 million, which would result in the liability of $30.45 million. So this is how we have actually written down the answer, first writing a general paragraph specifying what is the correct treatment and then applying that onto the scenario. Hill should recognize the following adjustments for correction, because the question even asked us to show the adjustments which need to be made to the consolidated financial statements. So we are writing down the adjustments, which should be the goodwill debit by $29 million and the deferred consideration credit by $29 million. So this is the adjusting entry for goodwill, and plus we are going to say finance cost debit by $1.45 million and the same deferred consideration credit by $1.45 million. So this is how we have discussed what was the correct treatment as well as the adjusting entries required to correct that. Any confusion in this? Although the question is not yet completed, you also have further to be read, but up till now, if there's any question, you people can ask me. You can post it in the chat box, or you can even post it in the chat message or the question answer session. Love Hong is saying, I asking out of topic, do your online classes include revision class and examinable for December 19? Love Hong, basically, the session that we are already having is going to be recorded and provided to you in the recorded form. So ideally, there is no need of a revision session, but most probably I'll be conducting the revision session of the Prepare to Pass from the ACCS platform as well. So that is going to be an enough revision for that. Abhishta is saying that what if the deferred consideration is to be paid after 3 months? How do you account for it? Abhishta, we actually calculate the present value only if the duration is 1 year or more. If the difference between the cash payment and the date of purchase is more than 1 year, only then we are going to calculate the present value. Otherwise, there's no need of calculating the present value. Okay, Javed Miadar is saying, is there any chance that we get your handout writing because I'm out at my office right now? I can just listen to the lecture, but I cannot write anything. No problem, Javed Miadad. I am going to upload all these documents today, and as I've told you that I've already created the links for you people. So you can actually access all of the documents from over there. Okay, so let's get back to the question now. And now we're going to read the second part of the paragraph. Lao Hong is saying how to make accounting entry for deferred payment. Lao Hong, we have already made the accounting entry. The goodwill debit and the deferred consideration credit by the present value of 29 million. And then we have unwinded it using the discount rate of 5%. Dulu Angel is saying that I've joined you due to poor network and this is my time. What is $32? Dulu, basically $32 million was the deferred consideration, which the question had said that we're going to pay after 2 years. So this is the deferred consideration payable after 2 years. Okay, now the second paragraph says that in goodwill calculation, the fair value of Chandler's identifiable net assets was deemed to be $170 million. So these are the fair value of the net assets. Of this, 30 million related to Chandler's non-depreciable land. Out of this, 30 million relates to the land. However, on 31st December 20x5, on 31st December 20x5, a survey was received which revealed that the fair value of the land was actually only $20 million at the date of acquisition. The value that the question is telling is the value at acquisition, but we actually received that value late. How much late? 3 months late. So ideally, if the updated value is received within 12 months from the date of purchase, we actually consider that as a pre-acquisition fair value adjustment, which again we had discussed during the last class. So we are going to decrease the value by how much? By $10 million. From $30 million to $20 million, we should be reducing this by $10 million. No adjustment have been made to goodwill calculation in respect of the result of the above survey. So we haven't incorporated this so far. So if I go back to the answer, we can say that all assets and all liabilities should be measured at fair value at the date of acquisition. And we can even be more precise, all assets and all liabilities of subsidiary should be measured at fair value at the date of acquisition. And this fair value can be measured up to 12 months from the date of acquisition. Now this is the general rule again. Now we are going to apply. In case of Chandler, the fair value of the land at the date of acquisition was reduced by $10 million after 3 months from the date of purchase, therefore should be considered as a pre-acquisition fair value adjustment. Hill should recognize the following adjustment to incorporate, or we can say for correction. So what is the entry? The entry is the goodwill debit and the land credit. But if you people remember, we have discussed two types of entries, a different entry for the full goodwill and a different entry for partial goodwill method. So let's see which method the question is following. It says that the non-controlling interest at acquisition was measured using the proportionate method. Proportionate method means the partial goodwill method. So that is why in the entry we are also going to write NCI debit. So we are going to debit the goodwill by the holding percentage, which was how much? Which was 80%. So $8 million will go to the goodwill and remaining $2 million will go to the NCI. So this is how again we have discussed the rule, applied it onto the scenario, and then we have concluded with the adjusting entries which the question actually had asked us. Any confusion so far? I hope my answer is easy to understand and completely in layman language so that you can easily replicate that. Okay, so no questions so far, that's good. Now the question further says that as at 30th September 2026, the recoverable amount of Chandler was calculated as $250 million. The recoverable amount of Chandler was calculated as $250 million, and no impairment has been calculated or accounted for in the consolidated financial statements. Now, this is something which is very important, and we're going to discuss this in detail on a separate sheet on one note. So now we are talking about basically impairment testing. Impairment testing of what? Impairment testing of a subsidiary. Now when we talk about the impairment testing, impairment basically is the difference of the carrying amount and the recoverable amount. So we can say the carrying amount minus recoverable amount is the impairment, and if this comes as a positive value, it is an impairment loss, and if this comes as a negative value, this means that there is no impairment loss. So this is the method of calculating the impairment. But when we talk about impairment of a subsidiary, how are we going to calculate the impairment loss? How are we going to calculate the impairment loss in case of a subsidiary? The method for that is that we are going to use or calculate the net assets, whatever the net assets are, and we are going to add the value of goodwill into that to get the carrying amount. The carrying amount is going to be the sum of the net assets and the goodwill. Net assets, which we normally calculate in working number 1, goodwill, which we calculate in working number 2, and if we deduct the recoverable amount from this, we are going to get an impairment loss. This is actually how we calculate the impairment of the assets. So now, if I say you that the net assets were, let's say, $100 million, the goodwill was, let's say, $20 million, and the recoverable amount was, let's say, $105 million, can you tell me the amount of the impairment loss quickly? Can you tell me the amount of the impairment loss quickly? Okay, $15 million is the answer from everyone, and that is right. Why? Because $100 million of the net assets, $20 million is the goodwill. So the carrying amount is going to be 120 million less 105 million, and we are going to get the goodwill impairment loss of 15 million, and this 15 million of the loss should first be recorded to the goodwill, because as per IAS 36 we recognize the loss first in the goodwill. So the entry is going to be retained earnings debit and the goodwill credit by $15 million. Yes, Dool is also right. So this is how we actually recognize the impairment loss. But if we see, this is the method of full goodwill method. This is the method that we follow in case of full goodwill method. Let's suppose if I say, how would your answer change if we use the partial goodwill method? This method was the full goodwill method. Now what if it is the partial goodwill method? What will happen? If I do the same working of the net assets being 100 million and the goodwill being 20 million, the total of 120, the recoverable amount of 105, and the loss of 15 million, can you tell me what is the mistake if I follow the same method in the partial goodwill method as well? What is the mistake in this? Okay, Dilpreet is saying that to add NCI to the carrying amount. Hasib is also right. Both of them are right actually. Basically, the problem is that the net assets represents 100% of the subsidiary, but the goodwill is only 80% because this, in case of partial goodwill method, is the goodwill of the parent only. But in case of full goodwill method, we have 100% of the net assets, 100% of the goodwill. So the sum is also 100% of the carrying amount, 100% of the recoverable amount, and we get a loss which relates to 100% of the subsidiary. But when we talk about the partial goodwill method, the loss is the amount which relates to the parent only. So this is a mismatch, 100% of the net assets and 80% of the goodwill. So either we need to gross up everything to 100% or we need to net off everyone to 80%. So both the methods are actually correct. So what we can do is we can basically shift everything to 80%. Like if I take net assets 100 into 80%, this means 80 million is the amount which represents to the parent only. Goodwill is only representing 80%, is already representing 80%. So this means now the net assets are also at 80%, the goodwill is also at 80%. So the carrying amount of 80% subsidiary is $100 million. Now we also need to take 80% of the recoverable amount, which is going to be 105 into 0.8, which is $84 million. So if we deduct $84 million from this, which is 80%, so we are going to get an impairment loss of $16 million, which also represents a loss to 80%. Now, what accounting entry are we going to make? For the accounting entry, we need to learn two entries, one relating to full goodwill and one relating to the partial goodwill. So before going to the entries, if there is any question till over here, you people can ask. That we have solved two different methods of calculating the impairment loss. In case of full goodwill method, we use this method. Everything was already at 100%, so we were not required to take the percentages. But in case of partial, we took 80% of the net assets and the recoverable amount so that all of the values, all of the calculations are in 80% form. Is this clear to everyone, or is there any question? Okay, Hasibullah is saying clear. Sufyan is saying, sir, yes, Sufyan, you can go on, ask a question. Okay, Cindy saying, do we have to make any adjustment after we take 80%? Yes, subsidiary. Yes, Cindy. Sorry, we are going to make the accounting entry just after this. Sufyan is saying, can you explain the difference between full and partial goodwill? Sufyan, I've already explained the difference in the last class. So you can actually get this from the recorded lectures of the previous class. Okay, so now we are going to make the accounting entries. And if I go down, what accounting entries are we going to make is, in case of full goodwill method, we have recorded 100% of the subsidiary. And in case of partial, we have recorded 80%. So if a partial goodwill impairs, we are going to make the entry as retained earning debit and the goodwill credit. No loss is allocated to the NCI. Why? Because there is no loss to NCI. The goodwill is only recorded in the parent shares. So when there is no loss to NCI, why to allocate to them? However, in case of full goodwill method, we are going to make the entry as the goodwill credit and the retained earnings and NCI debit. The loss that we had calculated was actually $15 million. So the entry we are going to make is going to be $15 million of the goodwill credit. 80% of that is going to be allocated to the parent and 20% will be allocated to NCI. So 50 into 18% and 15 into 20% is the breakup which is going to be allocated to the parent and the NCI. So any confusion with the accounting entry? Okay, so if we go back to the question, Dulu is saying what goodwill amount is included in partial goodwill method. Dulu, if we are talking about the partial, we are going to say that the goodwill was actually how much? The goodwill was actually 20 million. So out of the total of 20 million, 16 million of the goodwill has been impaired. So the loss, so the goodwill which will go to the statement of financial position is going to be $4 million only. However, in case of full, the goodwill of 20 was impaired by 15. So the goodwill of 5 million will go to the statement of financial position. So this is how we actually determine the value to be shown in the financial position. Okay, so if I go back to the question now, Dilpreet is saying, what if partial method we adjust to 100%, then we need to debit NCI? Dilpreet, if you adjust the partial goodwill method to make it to 100%, still you need to take 80% at the end, because you cannot impair, you cannot allocate the loss of goodwill to NCI in case of partial goodwill method, because there is no goodwill of NCI in that. Getting the point, Dilpreet? Cindy saying, can you write the concept of treatment of goodwill under partial? Cindy, are you talking about the impairment loss, or are you talking about the general treatment. Because if you are talking about the impairment loss, I'm already going to write it down because it was a part of the requirement of the question. So if I go to my Word file, I'm going to say, in case of impairment of goodwill, of partial goodwill, the impairment loss is the amount by which carrying amount exceeds the recoverable amount. The carrying amount and the recoverable amount are multiplied by the holding percentage of the parent before calculating the impairment loss. Any loss is only allocated to parent. In case of Chandler, now we are going to calculate in the case of Chandler. It says that the recoverable amount was $250 million. So if we apply the case of Chandler, what we are going to do, in case of Chandler, we are going to say that the net assets, we need the net assets, we need the goodwill, and this will give us the carrying amount, less we are going to deduct the recoverable amount. So if I go back to the question, the net assets were how much? The net assets were 170 million, but subsequently we reduced the land from 30 to 20. So this means the net assets were 170 minus 10, 160. Net assets were 170, which the question mentioned, but then we deducted 10 out of that. And we need to take 80% of this before calculating the loss. So 160 into 80% will give us the value of 128. We also need to calculate the goodwill, so we are going to deduct the cost. We usually add the fair value of NCI, but we are following the partial goodwill method. So the fair value of NCI is going to be 0. And the fair value of net assets that we have just calculated is 160. So we need to know the cost. And what was the cost? If I go back to the question, the cost was a cash of 150 and a deferred consideration of 32. So we are going to say cost of 150 plus the present value of deferred consideration that we had calculated was 29. Remember this, or should I show you in the answer? This is the value of 29 which should be taken to the goodwill calculation in the cost along with the cash consideration. So this is going to be 179. But because we are calculating the partial goodwill method, so net asset is also going to be 160 into 80%. So this was 128. So the goodwill is going to be 179 minus 128, which is going to be $51 million of the goodwill. Now these are the values at which date? At the date of acquisition. So the goodwill that we have calculated is 51. And the recoverable amount mentioned in the question was how much? It was 250 million. So we are going to take 250 million into 80%, which is going to be $200 million. But there's one more problem, which is very important, that we are testing for impairment at 30th September 2026, which is the year end, and the net assets were 160 at which date? At the date of acquisition. This means that we cannot use the net assets at acquisition to calculate the impairment loss. Rather, we need the net assets at which date? At the year end. So how can we calculate the net assets at the year end? Can anyone tell this? How can we calculate the net assets at the year end? Can anyone tell how can we calculate the net assets at the year end? Okay. Dilpreet is saying to add the net profits of Chandler into 80%. Good, Dilpreet. You are quite close. Basically, if I go back to the question gave us the profit of the Chandler, which was how much? 52 million. So if we add the profit of 52 million, yes, Cindy is also right. If we add the profit of 52 million, in the net assets at acquisition, we are going to get the value of the net assets at the balance sheet date. So it's 170 minus 10 at acquisition plus 52 will give us the net assets at the balance sheet date, and we're going to take 80% of that. So multiplied by 80% will give us the value of 169.6. So 169.6 plus 51 is going to be 220.6 minus 200 will give us an impairment loss of 20.6, and because it is the partial goodwill method, the entry is going to be retained earnings debit and the goodwill credit by $20.6 million. So this is how we were supposed to calculate the impairment loss in this question. Now this impairment loss was a challenging area of the question, but if something of this type repeats again, that is not going to be a challenging area, but it should be easy for you people. Any questions in this? So let's complete the answer. So we are going to say that in case of Chandler, an impairment loss of $20.6 million, which we will be showing in working number 1, should be recognized in profit and loss account. Hill should recognize the following adjustment, and the entry for that is going to be P&L or the retained earnings debit, and the goodwill credit by $20.6 million, and $20.6 million. And the rest of the working should be shown underneath this. So this is how this question was supposed to be solved. So if there's any question, you can ask me. Ashlan Khan is saying that I'm facing internet connectivity problems. So will the recording of the session be available? Yes, Ashlan. The recording will be available tomorrow. So there's no confusion on this. Nothing to worry. Julie is saying did not understand 52 million in the net assets. Julie, basically, the question had mentioned us that the profit during the year was 52 million. And the net assets at the date of acquisition were how much? 170 minus 10. And the date of acquisition was 1st October 20X5 when we were testing for impairment after 1 year. So this means what happened was, this is the entire year. This is the date of acquisition. This is the balance sheet date, and the profit for the entire year was $52 million, and the net assets at acquisition were $160 million. So if the opening net assets are 160 and the profit for the year is 52, so this will give us the value of the net assets at balance sheet date as 160 plus 52, which is going to be 212. So these are the net assets at the balance sheet date. Caroline is asking, do we need to give a summary calculation of goodwill? No, Caroline, there's no requirement of giving the summary. We are going to perform the calculation in its entirety. Like, let me give you an example. I am trying to open an Excel sheet. So in exam, you are going to write the complete answer of cost less fair value of net assets. The cost was 150 plus 29. The net assets were 160 into 80%, and the goodwill was the difference of these two. So this working should be shown in the exam. So we can call this working 2, and working number 1 is the actual impairment loss. So we are going to show net assets of 160 plus 51 into 80%, and then we're going to write goodwill, which we have already calculated in working 2, the carrying amount less the recoverable amount of $250 million into 80%. So this is the entire working that we need to show in the exam. So it's 160 plus 51 into 80%, and the goodwill was 51. So the sum was 200 and, okay, sorry, this is not 51, this is 52. This is also 52, and equals to 250 into 80%. So this minus this is the amount of the impairment loss. So this is a complete working that needs to be shown in the exam. And if I'm writing the answer, I'm going to copy this and I'm going to paste this over here. So this is how we are supposed to give the answer in the exam. So any confusion? Cindy, I hope you are clear. Okay. So let me show the screen again. Actually, I think the screen got paused. So Carolyn, this is how basically we are solving the impairment loss. We wrote the net assets, the goodwill, sum, the recoverable amount, the impairment loss, and the calculation of goodwill. So the entire working needs to be shown in the exam clearly so that the examiner knows what value are we getting from where. Okay, so now basically we have done one of the past papers questions. Now we are going to solve the remaining area which was left during the last day, the area of the contingent consideration. So let me open that. And this is the slide that we were supposed to do. So we had actually discussed in the last part of the deferred consideration, and now we are going to continue from over here. So we already discussed the deferred consideration. Now the next area is the contingent consideration. Now when we talk about the contingent consideration, there are two types of contingent consideration. Either it is going to be in cash or it is going to be in shares. So we have two different slides, one relating to cash, one relating to shares. So let's start from the contingent consideration in cash. During the year, parent acquired 80% of subsidiaries 100 million shares. So out of a total of 100 million shares, we have acquired 80% of that. So 80 million shares of subsidiary have been acquired, 80% of 100 million. In exchange, parent will pay $2.42 per share after 2 years. So if I use the calculator, 80 million into 2.42 is going to give us a value of 193.6 million dollars. So this is the amount of the consideration that we are going to pay after 2 years if subsidiaries reporting profit in both the years if subsidiary reported profit in both the years. So this is the condition that the subsidiary should report a profit in both the years in order to get the deferred consideration. So because we have got a condition over here, that is why we're going to say that this is a conditional payment, this is a contingent consideration. So now if the chances are virtually certain or probable or possible or remote, the accounting should be done in the same way. Okay, just give me a minute. My laptop actually just got disconnected.
Oh.
Okay, so let's resume. So we were discussing that in case of contingent consideration, what will happen is, let me start again so that the disconnectivity does not create a problem. So in case of contingent consideration, during the year, parent acquired 80% of subsidiaries, 100 million shares. So 100 million into 80% is what we have acquired, 80 million shares. In exchange, parent will pay $2.42 per share after 2 years. So $2.42 after how many years? 2 years. So this will give us a value of what we had calculated was 80 million into 2.42 is going to be $193.6 million from the date of acquisition if subsidiary made profit for both the years. So this is the condition that needs to be met in order to get the consideration. So conditional consideration is what is called contingent consideration. Conditional consideration is what is called contingent consideration. So maybe we are going to pay this and maybe we are not going to pay this. Now, normally the contingencies are accounted for in IAS 37. Normally the contingencies are accounted for in IAS 37, but IAS 37 does not apply in case of IFRS 3. So in case of consolidation, we are not going to apply IAS 37 onto that. So the question says, which was considered to be possible only. Now, even if it's virtually certain, probable, possible, or remote, in all these cases, we will always record the contingent consideration in case of IFRS 3. So when it comes to business combination, we are going to record this in every case. Now the question says that the cost of capital was 10%, so we are going to divide it by 1.10 to the power 2 to get the present value, and if I use the calculator again, it is going to be divided by 1.1 to the power 2. So this will give us a present value of $160 million. So we are going to make an entry as the goodwill debit by $160 million and the contingent consideration credit by $160 million. But one thing which is again important, that let's say the question would have said that there are 20% chances. If I say that there are 20% chances of the condition being met. So if the question gives us the chances, what we are going to do, that rather than recording entire 160 million, we will be recording 160 million into 20%, which is going to be $32 million. So in case of contingent consideration, when it is in the form of cash, we calculate the expected value. 32 is the expected value of the present value, which means $160 million of the cash flows. So first we are going to calculate the cash flows, then we are going to calculate the present value, and then we are going to calculate the expected value. So this was the cash flow, this was the present value, and this is the expected value, and we are going to make the entry by the expected value in actual. Yes, Mr. We are going to do that. So all these three impacts should be taken. Now, whenever we calculate anything at present value, we need to unwind that every year. Anything which is calculated at present value needs to be unwound every year. And similarly, anything which is calculated at its expected value needs to be reassessed at each year. So now in case of contingent consideration, what we need to do? In case of contingent consideration, what we are going to do? First, we are going to calculate the cash flow. This is what we are going to do at acquisition. Second, we are going to calculate the present value. Third, we are going to calculate the expected value. Now at each year end, we need to unwind the liability, plus we need to reassess the liability, and any change, if there's any change, we are going to account it for, any change accounted for in P&L. So if there's any change, we are going to account it for in the profit and loss as a gain or as a loss. So three impacts: calculate the cash flow, calculate the present value, calculate the expected value at the acquisition date, and then we need to unwind and reassess with gains and losses taken to the P&L. So this is what is to be done in case of the contingent consideration. But the contingent consideration which is in the form of cash. But if the contingent consideration was in the form of shares, the treatment would be different. So let's understand the cash first. If there's any problem, you can ask. Then we're going to discuss the shares as well. Stephen has raised his hand. Stephen, you can ask your question. Okay. So now let's discuss what if the contingent consideration was in the form of shares. If the contingent consideration is in the form of shares, let's see. The question says during the year parent acquired 80% of subsidiaries, 100 million shares. So 100 million shares into 80% is going to be 80 million shares of subsidiary. In exchange, parent will issue 2 shares for every 5 after 2 years from the date of acquisition if subsidiary made profit in both the years. So this is the condition which makes it a conditional consideration, which means a contingent consideration. But this time the consideration is going to be in the form of shares. So we are going to give 2 of our own shares for every 5. So this will be how much? 20 million? No, 32 million. So this will become 32 million shares of parent, which was considered to be possible only. Again, this does not matter what is possible, probable, virtually certain, or remote, because we are going to record the transaction in every case. Market value of each share at the date of acquisition was $4. So this means if I multiply it by 4, I'm going to get a value of $128 million is the value of these shares. And there's a 20% chance that the target will be achieved by subsidiary. So if there's a 20% chance, we're going to calculate the expected value, which is going to be $25.6 million. So this is the value by which we should be recording an entry as the goodwill debit by 25.6 million. And because this is in terms of shares, this is not a liability. Rather, shares are a part of equity. So we are going to credit the equity by $25.6 million. So this is how we actually record the transaction. And when we say equity, equity means the share capital, the retained earnings, the revaluation reserve, the share-based payment reserve, which is as per IFRS 2, any other reserve, any general reserve. All these reserves are a part of equity. So normally, to make it easier, what we can do is we say that apart from share capital and retained earnings, the remaining reserves are known as other components of equity, which in short we can say OCE. So we can even say it's goodwill debit and OCE credit, which means a separate reserve should be created for this $25.6 million. So when we talk about the shares, when we talk about contingent consideration in shares, what we do at acquisition is we calculate the market value of the shares and we directly calculate the expected value. So there's no need of calculating the present value in this because, why? Because present value is only calculated for the cash flows. And in this case, we are not giving any cash flow. That is why there's no need of calculating the present value. Now there's one more important thing, that what accounting is to be done at the year end? The answer is nothing. Because equity is never ever remeasured. So we do not need to remeasure the value that we have calculated initially. In case of cash, we do unwind it, we do reassess, but in case of equity, we are not going to reassess that or we are not going to unwind that. So equity is never ever remeasured. Any confusion so far? So the last part of the basic workings is going to be the transaction cost. If there is any transaction cost which is paid to acquire a subsidiary, such as any legal cost, any cost to transfer the shares onto our name, any brokerage cost, any commission cost paid to the agent through whom we are purchasing the shares, any cost we have paid to the legal advisor or the financial advisor, that at what price should we be purchasing. All these are an example of the transaction cost. So what is the treatment of transaction cost? We are going to expense it out to P&L. We are going to expense it out to the P&L. So the question says, during the year, parent acquired 80% of subsidiaries, 100 million shares. Parent had to pay some legal cost of $2 million to acquire the subsidiary. The cost has been recorded as part of the investment in subsidiary. although this should be expensed out. So our correcting entry is going to be P&L debit and the goodwill credit by $2 million, because any legal cost or the transaction cost should not be capitalized, rather it should be expensed out. Mudassar is saying it's getting difficult to absorb the knowledge. So if you can slow down the pace. Okay, Mudassir, I am slowing down the pace. And even Mudassir, the lectures are recorded. So if you have any problem, you can redo that. You can go through them again. And if you still have any questions, you can ask me on the WhatsApp personally. So don't worry if something is getting fast. You have the video lectures, you can go through them again. And I am going to break these lectures topic wise so that you can directly go on to the topic that you need to revise. Okay, so now let's take a break. Let's take a break. It's 9:30. So we are taking a break of 15 minutes. Dulu saying, what do we do with the figure recorded as part of investment? Dulu, basically anything recorded as part of investment ultimately goes to the goodwill. So correcting goodwill means correcting the investment. So we are taking a break of 15 minutes and then we are going to get back again to continue the lecture. We will solve one more past paper question first and then we'll move towards the topic of the disposal. So let's have a break and then come back again. Till then, have some rest, take some drinks and come back. Okay, everyone, welcome back. Now we're resuming the session and we're going to solve one more question relating to the basic consolidation. And this is specimen question number one. Specimen one, question number one, by the name of Kuchin. So let's start from the requirement. Requirement has part A and part A1 and 2, which relates to the consolidation. Out of which part A1 is the one which relates to general consolidation. Part 2 is the one which relates to the area of disposal. So if I read question A, part 1, it says, explain to the directors of Kuchin with suitable workings how goodwill should have been calculated on the acquisition of house and match. Showing the adjustments means show the double entries, accounting entries, which need to be made in the calculation of goodwill. So let's go at the start. And this is the acquisition of house. This is the acquisition of match on which we have to apply the discussions. It says that on 1st June 2006, Kuchin acquired 70% of the equity interest of house. The purchase consideration comprised 20 million shares of $1. So in consideration, we have given our own shares at the acquisition date and a further 5 million shares on 31st December 2007, which means approximately 1.5 years after the date of purchase, if house's net profit after taxation was at least $4 million. So this means there is a condition applied onto this, which means this has become a contingent consideration which is to be paid in the form of shares. So in this we have a simple share exchange, share consideration, and a contingent consideration. The market price of Kuchin shares at 1st June 2006 was $2 per share. So this is going to be used to calculate the value of the shares. And that of house was $4.2 per share. So the question is also giving us the share price of the subsidiary, which will be used to calculate the fair value of the NCI. It is felt that there's a 20% chance of the profit target being met. So this is going to be used to calculate the expected value of the deferred consideration. If I quickly solve the question of Kuchin, I'm going to say that one, we are giving shares, how much? 20 million shares of $2 each. So $40 million is given in the form of share exchange. Plus, we are giving some contingent shares as well, which were how much? 5 million shares of $2 with a 20% chance. So this is going to be 5 million shares of $2 with a 20% chance. We'll make it a total of how much? Again, 2 million. So this means that the total purchase consideration is going to be $42 million, which is going to be used in the calculation of goodwill. We are going to use $42 million in the calculation of goodwill. Is it clear to everyone? Let's read the full question and then write down the answer, because this is the best practice that you also need to follow in the exam. First read the entire part and then write it down. So it further says, in accounting for the acquisition of house, the finance director did not take into account the non-controlling interest in the goodwill calculation. He determined that a bargain purchase of 8 million arose. Bargain purchase means negative goodwill. Bargain purchase means negative goodwill. So we say that the goodwill will either be a positive goodwill or a negative goodwill, and negative goodwill is called a bargain purchase. So a positive goodwill is shown in the statement of financial position as a non-current asset, and negative goodwill is shown as a gain in profit and loss account. So negative goodwill is treated as a bargain purchase, as a gain in the P&L. So it says that the director has calculated a bargain purchase of 8 million on the acquisition of house. Being the purchase consideration of 40 million, the finance director has used 40. Although according to us, the consideration is how much? The consideration is 42. So the finance director has not included this 2 million in the goodwill, less the fair value of the identifiable net assets of house on acquisition of $48 million. So here we use the value of 40 minus 48 to get a negative goodwill of 8 million. This valuation was included in the group financial statements above. Although this value is incorrect, so we need to correct that. Let's read further and then correct it once and for all. It says, after the directors of Contingent discovered the error, they decided to measure the non-controlling interest at fair value, which means they are entrusted to follow the full goodwill method. The fair value of the non-controlling interest in house was to be based upon quoted market price at acquisition. So we are going to calculate NCI based on the quoted market price, which was $4.2. House had issued share capital of $1 each, totaling $13 million. This means that the number of shares were also 13 million at 1st June 2026, and there has been no change in this amount since acquisition. So this means if we calculate the fair value of NCI, there were 13 million shares of the subsidiary, out of which we have acquired how much? 70%. So remaining 30% belongs to the NCI, and every share is of $4.2, this amount. So 13 into 30% into 4.2 will give us the value of NCI being $16.38 million. So this is the value of the NCI. And the fair value of net assets is how much? $48 million, which the question informed us over here. So if I calculate goodwill, I'm going to use the cost of $42 million plus the fair value of NCI of $16.38 million, giving a total of $15.38 million, less the fair value of net assets of $48 million. So the total is going to be $10.38 million. So this is how we should be calculating. This is the correct method. And what the question has done is actually the question used 40 and deducted 48 to get a negative goodwill of 8. This is what the question has done, and this is what the correct method was actually. So now if we want to make the accounting entry, what entry are we going to make? Let's make it down. We are going to say that first we should be eliminating the negative goodwill by 8 million by debiting it. We should be eliminating the negative goodwill by 8 million by debiting it. Then we should be recording the goodwill of 10.38 million by again debiting the goodwill. So we have eliminated the negative goodwill by 8. We have debited our own calculated goodwill by 10.38. And now the first error was that the question had not recorded the contingent consideration in shares. So we are going to record that in OCE by 2 million. Second, the question has not recorded the value of the NCI. So we are going to credit the NCI by $16.38 million. So this is the correcting entry which the question should make to correct its financial statement. So this is what now we are going to write in the theoretical form. So if I go to my Word document to write it down, and this is specimen 2. So just copy pasting it. This time we are solving specimen 1, question 1, part A. And we're going to say that when calculating goodwill, and we should include all types of purchase consideration, including any contingent consideration in the form of shares, which is included at the expected value of the market value of the shares. In case of house, Cochin should include $2 million, which is 5 million shares into $2 into 20% in the purchase consideration while calculating goodwill. We can add a word also. So apart from 40, it should also include $2 million in the goodwill. Further, the value of NCI should be $16.38 million, which is 13 million shares into 30% NCI into $4.2 of the share price, which will give a goodwill of $10.38 million. Cochin should recognize the following adjustment for correction, and we're going to say goodwill debit by $10.38 million, P&L debit by $8 million, and we can say this is to reverse the bargain purchase recorded by the finance director. So I'm writing for you people understanding, not for the examiner. We can just say recorded. Now the next thing is we are going to credit the NCI by $16.38 million, and we're going to credit the OCE by $2 million. So this is how we have written the first part of our answer, and now we are going to write the next part which relates to the other subsidiary. Any confusion in this? Okay, no questions. So now the next part says initial acquisition of 80% of match. It says that on 1st January 2006, Kuchin acquired 80% of the equity interest of Match, a privately owned entity, for a consideration of $57 million. So this time we have paid a consideration of $57 million for the other subsidiary. The consideration comprised of cash of $52 million and the transfer of non-depreciable land with a fair value of $5 million. In case of a consideration, which is in the form of asset, what do is we actually debit the goodwill by the fair value of the asset, and we actually credit the asset by the carrying amount of the asset, and this actually results in the balancing figure taken to the P&L, which is actually a gain or loss on the disposal. So this is what the entry usually is. Now in this question, it says that we have given cash of 52 and a fair value of land of 5, which adds up to 57. So far the accounting treatment is right. It further says that the carrying amount of the land at the acquisition date was $3 million. So ideally the correct entry is goodwill debit by 5 million, the land credit by 3 million, and a gain of 2 million taken to the P&L. This is the correct entry that should be made. But what has the question done? It says, and the land has only recently been transferred to the seller of shares in Match and is still carried at $3 million in the group financial statements. This means that the question has not made this entry. This entry is actually unrecorded, so we are going to record this entry. So far our objective was to record the exchange of the asset as a consideration. Now the question further says at the date of acquisition, the identifiable net assets of Match had a fair value of $55 million. So now we can calculate the goodwill as well. Match had made a net profit attributable to ordinary shareholders of $3.6 million. This is the profit attributable to ordinary shareholders. Okay, for the year ended 31st December 2025, the directors of Kuchin wishes to measure the non-controlling interest at fair value, which again means the full goodwill method, at the date of acquisition, but had again omitted NCI from the goodwill working. So we again need to add the same thing as the previous question, previous part. The NCI is to be fair valued using a public entity market multiple method. The directors of Kuchin have identified two companies who are comparable to Match. Basically, this method is nothing as such. Rather, the question is automatically going to tell us what we are going to do. So we have got two companies who are comparable to Match and who are trading at an average price to earnings ratio of 21. So this is the average P ratio. The directors have adjusted the P ratio to 19 for the differences between the entities and Match for the purpose of fair valuing the NCI. So we are going to use this P ratio for what purpose? To calculate the NCI. Now when we say PE ratio, PE ratio means market value divided by the EPS. So if I solve further, I'm going to say PE ratio that they have calculated is 19, which means market value divided by earnings is 19. So if the earnings was $3.6 million, this amount, this means that the market value can be calculated as 19 into 3.6 million. So 19 into 3.6 million will be $68.4 million is the market value of the entire company. Out of which, how much have we acquired? We have acquired 80%. So remaining 20% belongs to the NCI. So 68.4 million into 20% is going to be $13.68 million. This is the fair value of NCI according to the question. Are you people getting this point? Okay, Mudassir is saying, please repeat again. Mudassir, basically, the PE ratio means market value divided by the earnings. If we keep earnings per share, we will get the market value per share. And if we keep the earnings in total, we're going to get the market value in total. So the question gave us the earnings of $3.6 million of the entire company. So what we did is we used this $3.6 million in our working to calculate the market value. So market value divided by earnings of 3.6 is equals to 19. So 19 into 3.6 will give us the market value of the entire company. And then we took 20% of that to get the value of the NCI, which was $13.68 million. Getting the point, Mudassir? Okay, so let's get back to the question. It further says that the finance director has determined that a bargain purchase of 3 million arose on the acquisition of match. So again, they have calculated a negative goodwill, which means they would have taken to the P&L, being the cash consideration of 52 million, which again means that they have ignored the land of 5 million, less the fair value of the net assets of 55 million. The bargain purchase has been included in the group financial statements above. So let's calculate the goodwill again. So we are going to say that the cost should be the cash of 52 plus the land of 5, which will make it 57. The fair value of NCI that we have just calculated is 13.68. So the sum will become 70.68. And if we deduct the fair value of the net assets of 55, we're going to get a goodwill of 15.68 million. So this is how we have calculated the correct goodwill. And what the question did, it actually used 52, ignored the value of NCI, deducted 55, and they had got a negative goodwill of 3. So this is what was done by the question and the correct solution as well. So now we need to make the accounting entry, for which we are going to say, first we are going to debit the negative goodwill of 3. Then we are going to debit our correct goodwill of 15.68 million. Now they forgot to credit the land in the P&L. This one, these one. So we are going to credit the land by 3 million, the gain on disposal by 2 million, and the value of NCI that they had forgotten was 13.68 million. You can check that the debit and the credit should actually match. So this is the correcting entry that should be made in the financial statements to ensure the correct accounting treatment. Is it clear to everyone? Okay, so if there's any question you people can ask. So let's write down the answer as well. Okay, so if I'm writing down the answer, continuing the last part, we're going to say that in case of match, Kuchin should also include the asset given as a consideration for how much? $5 million, with a gain of $2 million being recorded in the P&L. Further, Kuchin should also include the fair value of NCI of $13.68 million, which we have calculated as 19 into 3.6 into 30%. This is what we did. Let me check, into 20%, which would result in a goodwill of $15.68 million. Kuchin should recognize the following correcting entry, in which we are debiting the goodwill by $15.68 million. We are removing the bargain purchase of $3 million. We are recording the NCI by $13.68 million. We are crediting the land by $3 million and recording the gain on disposal of $2 million. And this was the reversal of bargain purchase. So this was the second question that we have solved today. We first solved the question of specimen 2, and then we have solved the question of specimen 1. In both the questions, we had the general accounting treatment of the goodwill, the purchase consideration, fair value adjustments, and so on. Any confusion so far? Okay, That's good. There are no confusions so far. So now we are going to continue with the area of disposal of the subsidiary, which is also one of the important areas of consolidation. Okay, so now we are discussing the area of disposal, which is also a part of consolidation, IFRS 3. And in case of disposal, we have 4 different cases. In fact, there are 5 different cases. There's one more case that I'm going to write it manually. Mudassir is saying, sir, it's better if we keep disposal for the next class and quickly revise what we have learned so far. Mudassir, basically, I would recommend to continue with the disposal because the course is too big and we need to cover the entire course within the time duration. So the lectures will be recorded. You can have a quick recap and we can have a separate recap in the final consolidation class to discuss what we have studied in total. Okay. So in case of disposal of subsidiary, what do we do? Let's say first case, we had a 70% owned subsidiary and we disposed of entire 70% holding and now our new holding is 0. This is the first case that we are going to discuss. In the second case, we had 70% holding, we disposed of 60% of that and now we are left with only 10% of the holding. In third case, we had 70% holding, we disposed of 40% and now we are left with an associate of 30%. And in the last case, we had a subsidiary, we disposed of 10% and now we have a remaining of 60%. So these are 4 different cases and the 5th case will be that if we have an associate of let's say 40% and we dispose of 30% shares so that the remaining holding is a simple investment of 10%, how the accounting is going to be. So these are 5 different cases that we should be aware of. So let's start with the first case that we have disposed of an entire subsidiary. What do we do if we have disposed of the subsidiary? We actually credit the net assets of that subsidiary, credit the goodwill and debit the NCI. Using these 3 values, we actually de-recognize the subsidiary from our financial statements. So when we have disposed of a subsidiary, there is no need of consolidating the net assets, no need of consolidating the goodwill, no need of consolidating the NCI. So we actually eliminate all of these, removing the goodwill by crediting it, removing the net assets by crediting it, removing the NCI by debiting it. And the disposal proceeds that we have received will be debited in the bank. And the remaining investment, whether it's an associate or an investment, is going to be debited. So either it is going to be a simple investment or it is going to be an investment in associate, both of them. So this is the entry that we are going to make, and the investment in associate will be debited by the fair value of the remaining holding. So it is going to be the fair value of 10% in the first case, fair value of 30% in the third case, and the balancing figure will go to P&L as gain or loss on disposal. So basically what we are doing, we are making the accounting based on an assumption that We haven't sold 60% of the shares, rather we have sold entire 70%, and then we have purchased 10%. That is why first we are de-recognizing the 70% owned subsidiary, and then we are recognizing our investment in associate. So the assumption is that we have sold the entire holding and we have repurchased the remaining holding. So this is how we actually accounted for. Similarly, if we talk about the fifth case, the assumption will also apply over here. That we had an associate, we have sold 30% shares, we have got 10% shares. So if I assume that I have sold the entire associate, I should be crediting my investment in associate, credit, and I should be debiting the remaining investment of 10% as debit. And the cash that I would have received to dispose of the 30% shares with the balancing figure taken to the P&L. Vista is saying that when you say fair value of net assets, is the fair value of net assets on the date of disposal or the fair value of net assets at the date of acquisition? Basically, Vista, we are going to take the fair values at the date of disposal. All of the fair values will be at the date of disposal. All the fair values will be at the date of disposal. So in case of associate to investment, again, we are assuming that first we have disposed of the investment in associate by crediting it. Then we have purchased the simple investment by debiting it. The bank being a debit and the balancing figure taken to P&L. Any questions in this? We can ask the questions quickly. Okay, no questions so far. So now if we discuss the last case from subsidiary to subsidiary, the accounting will be a bit different in this case. Let me use the OneNote for that. So let's suppose we have a subsidiary where we have 70% of the shares and we disposed of 10% of the shares to get 60% remaining holding. Now in this case, what will happen is, rather than assuming that we have disposed of 70% and reacquired 60%, the treatment is different. The assumption will not apply onto this case. Rather, what we are going to do, if we have disposed of 10% of the shares, this means that the NCI, which was previously 30%, has now increased to 40%. The NCI, which was previously 30%, has now increased to 40%. So we are going to make an entry as the bank debit by the disposal proceeds of the 10% shares, bank debit by the disposal proceeds of the 10% shares, and we are going to credit the NCI because the NCI is increasing from 30% to 40%. So we should be crediting the NCI by how much? If I prepare working 3 of the NCI, we usually start this from the fair value of NCI, which will be at the 30% rate, and then we add the share of profit of NCI by same 30% rate, which will give us the value of 30% of NCI. And because we need to increase it by 10% to bring it to 40, what amount we are going to write is basically the acquisition, or we can say the increase of NCI. Acquisition may actually confuse you. So the NCI is going to be increased by this value divided by 30% multiplied by 10% will give us the value by which the NCI should be increased. The value of NCI divided by 30% multiplied by 10% will give us the value by which the NCI should be increased. Are you people getting the treatment? So we can say that we are going to credit the NCI by the amount of NCI divided by the NCI percentage into the percentage that we have disposed of will give us the value by which the NCI should be credited. And after this, the balancing figure is going to be the other components of equity. Basically, this is a type of a gain or loss, but this is not going to be recorded in the P&L, rather it is going to be recorded directly in the equity. So this is a type of a gain or loss which will be recorded directly in the equity. Is it clear to everyone? Any confusion so far? The still is saying that your voice is breaking. Is this an issue for others too? Mudassir is saying that your voice is breaking. Is this an issue for the others too? Okay, Carolyn is saying that it's fine. There's no issue on Carolyn's side. So maybe Mudassir, your internet connectivity maybe the issue behind this. No problem on Cindy's side too. Okay. So now let's get back to the question. And now we are going to continue the same question with the next part where we have the disposal. Mudassir is saying that why do we credit to OCE and not P&L? Mudassir, the simple reason behind this is actually when we see this is a transaction recorded in the NCI, and NCI is a part of equity. NCI is a part of equity. Therefore, we call this transaction as an equity transaction. We call this transaction as an equity transaction, and all of the transaction which relates to equity, the gain or loss is directly recorded in equity. So this is why we are not taking it to the P&L, rather we are taking it directly to the retained earnings or the equity. Mr. saying, yes, I thought the disposal of part of subsidiary is based on assumption that the whole subsidiary is sold. How come the assumption does not apply? Mr. Basically, the assumption does applies onto all of the other cases. The assumption applies on these and this cases. But the assumption does not applies onto the subsidiary to subsidiary case. So there's only one case where the assumption will not be applied. There's only one case where the assumption will not apply. So now let's get back to the question, and we have a separate part, which is part 2 for the disposal. Let's try this off, and then I'm going to give you a homework for the next class, which will be a question of disposal, which you have to try on your own. So let's read this. It says that explain with suitable calculations how the gain or loss on sale of niche should have been recorded. The question is asking the correct amount of the gain or loss. If we see, the question is not asking us to make the entry for the correction. So we are just required to tell the correct amount of the gain or loss for 5 marks. So let's read the question, which says that Kuchin had purchased 80% of niche for $40 million. So this is the purchase price that we have paid to acquire 80% of the shares. On 1st January 2026, when the fair value of the identifiable net assets was 44, the partial goodwill method had been used. So we are following the partial goodwill method, the proportionate goodwill method to calculate goodwill, and an impairment of 2 million had arisen in the year ended 31st December 2026. So the goodwill was also impaired by 2 million. So if till over here I want to calculate the goodwill, which is normally working number 2 that we solve, the cost of acquisition was $40 million. Because we are solving the partial goodwill method, there is no fair value, and the fair value of net assets will be 44 million into 80% because we are following the partial goodwill method. So 44 into 80% will give us 35.2 of the net assets, and this will result in the goodwill being $4.8 million, after which there was an impairment loss of $2 million. So the goodwill after impairment is $2.8 million. So this is the first part that we have calculated. I hope there is no problem in this. So if I go back to the question, it further says that the holding in niche was sold for $50 million on 31st December 2086. So we have sold the investment after a year, from 1st January till 31st December. After the year, we have sold the subsidiary for $50 million. So apparently, because we have sold all of the shares, we can say we should be debiting the bank by $50 million. To de-recognize the subsidiary, we should credit the net assets, we should credit the goodwill, and we should debit the NCI, with the balancing figure taken to P&L either as a gain or as a loss. So goodwill, we have already got $2.8 million, which we have calculated over here. The question further says that the carrying value of niche identifiable net assets other than goodwill was $60 million at the date of sale. So the question has also given us the net assets of $60 million. So we just need the NCI, the balancing figure of P&L. And the question further says that Cochin had carried the investment in niche at cost. This means the question is talking about the individual financials. In individual financials, Cochin had carried the investment at cost. The finance director calculated that a gain arose of 2 million on the sale of niche. In the group financial statements, being the sale proceeds of 50 less 48 being their share of the identifiable net assets. But we are not required to talk about the incorrect treatment, because the question was asking how the goodwill should have been calculated. So there's no need of discussing this in the answer. This was credited to retained earnings. So this means from here till here, there's nothing to do with this information. But the question has not informed us how to calculate the NCI. So now what to do? To calculate NCI, we will have to solve working free. And because it is a partial goodwill method, the NCI at acquisition will be $44 million of the net assets into 20%, which is going to be $8.8 million of the NCI at acquisition. And the net assets at that time was 44. So the net assets at acquisition were 44. And if we see at the balance sheet date or the disposal date, the net assets were now 60. So if we need to calculate the profit was how much? $16 million, out of which 20%, $3.2 million belongs to the NCI. So if we add the share of profit of NCI of $3.2 million, we are going to get the value of NCI of $12 million. This is how we calculate the value of the NCI. So NCI should be debited by $12 million in this case. So now we have got all the values, and we have a message. Mudassir is saying, sir, explain 3.2. Mudassir, the net assets at the date of acquisition were 44, which we have used to calculate the goodwill as well. And the net assets at the balance sheet date were 60, which we have kept over here. So this means that there was a profit of $16 million from acquisition till the balance sheet date, in which NCI had a 20% share. So 3.2 million is the share of profit of NCI, which we have written over here. Getting the point, Mudassir? That's good. Mudassir is clear on this. So now if I calculate the balancing figure, the debit is 62, the credit is 62.8. So there's a loss of $0.8 million on this transaction. So the balancing figure has given us a loss of $0.8 million. So this is what was to be done in this question. Okay, sorry, I think the audio got muted automatically. So this is what was supposed to be the question. Cindy is good now. That's good, Cindy. So that was the question that we have just solved. And now in homework, you actually have to do the second question, the one that we did earlier by the name of Hill. And this has a part of Doyle, disposal of 20% of Doyle. This is the part which you people have to do. This is specimen exam 2. You can download it from the ACCA's website. And plus, I will also share the link. It has a part 2, which is to be tried as a homework by you people. So do solve this as a homework and you can submit me your answers on my email address at hmzabdulhaq@the rate hotmail.com. So this is my email address. You can send me the answers for a feedback, and I will send you my reply in a day or two. So that was all for the topic of disposal. If you people have any questions, you can ask. After the homework, we will also be having a test, an exam for disposal questions. So we have sort two questions, one in the homework and one as a test. So if there's any question, you people can ask me quickly. Okay, no questions so far, so that's great. That was all for today's session. Thank you everyone, and looking forward to meet you all in the next class, which will be on Thursday, day after tomorrow, continuing with the area of consolidation. Ibista is saying you haven't shared the payment details. How can we pay? Ibista, let me tell you. Actually, you people can pay on the PayPal link for our system. So it's paypal.me/payibf. You can pay the amount of the fee onto this link. So this is how you are going to pay the amount. And because there were two classes allowed, the demo classes from Thursday, I would prefer you people to pay the fees till then, so that it's easier for all of you to take the classes. Dulu is saying, how do I get one recording as I was not present? Dulu, you can message on the WhatsApp. I will share the link with you so that you can cover it over there. Cindy is saying, sir, can we have offer tests? Yes, Cindy, this is what is the plan, because the more the test, the more you are prepared for the exam. Julie is saying, how can we obtain invoice? Julie, I will send you the invoice using the PayPal, so you can directly pay on that invoice, plus as well as you also have a downloadable invoice for this. So most probably I will share it to you by tomorrow, so that it's not difficult for you to join the class on Thursday. Any other questions from anyone? Okay, great. So thank you everyone. Looking forward to meet you on Thursday. Till then, take care and Allah Hafiz.